How to easily outperform robo-advisors. It's easy to outperform robo-advisors. Why? They don't even try to outperform. They try for reasonable returns with less risk. So robo-advisors are big investment companies, not financial planners. They're more likely to lose a client because of a 30% one-year decline than 10 years of lagging the index. So they focus on market fluctuations, not your life goals. This makes them use what I call performance drags that typically reduce the returns by 1 to 3% per year. For example, they use bonds a lot. They try to force you to buy bonds, even though studies show that over 20-year periods, equities, like stocks, are more reliable. They have a lower 20-year standard deviation after inflation than bonds. So they have a home country bias. They invest in Canada because it sounds safer, even though the returns have been 1 to 3% per year lower than global stocks. Canada's index is not a diversified portfolio. It's a resource and financial sector fund. They also do what I call riding the brake. They have many ways to invest more conservatively, like dividend, low volatility, or covered call ETFs. They sound good, but give you lower long-term returns. So I talked to an engineer recently who was quite an aggressive investor, young and knowledgeable, and he said he'd gone to a robo-advisor and he gamed the risk tolerance questionnaire. He just answered the most aggressive way in every single question, and it's still they forced him to have 20% bonds. So we called in, talked to the portfolio manager, and even then, the best they could do is 10% bonds. So he called me up. He says, I don't want bonds. How do I get something better? Why are they forcing me to buy bonds? And I remember talking to a few people online who were investing with robo-advisors. This was the middle of 2017, and they were complaining that their robo-advisor was 10% behind the index year to date. That was only a 6-month period. So I looked back at the beginning of the year of 2017, and they had that robo-advisor had low volatility and smart beta ETFs in their portfolio. By the middle of the year, they'd switch back to the broad indexes, but they tried to put these things in that sound safer, but it ended up lagging the index by a huge amount. So it's easy to outperform robo-advisors because they are big companies with compliance rules that are more important to them than your life goals. They give you what I call as compliance advice to protect their company, which means you cannot even invest 100% in equities. So just get the return of the global US equity index and you outperform robo-advisors. You could use one broad index ETF or invest with top fund managers that outperform. So we invest for above index returns, actually, with an elite portfolio manager that finds the world's best investors that all have 15 to 30-year track records beating the index after all fees. So most fund managers lag, but just like any field, there are some amazing people that outperform. So we try to beat the global equity index after all fees, including ours, so that our fee-for-service financial planning advice is purely value added. Don't invest for reasonable returns with less risk. Invest for maximum reliable long-term total returns. So details, if you want, or the background for this are in my post from my full post last week in this blog. My blog is edrempel.com. It's the #1 blog in Canada for a financial planner. If you're interested in potentially talking with us, just go to edrempel.com/talk. Thanks for listening. We'll see you next week.